Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. In the past year, you may have heard and known the words GameStop, along with the stock market, Wall Street bets, and even Robinhood, as they were linked to some of the most contentious financial news stories of the year. This is because of the statements that GameStop's market share is overstated and that it is destined to crash. Before you can even consider that one stock is doomed to crash, you need a lot of trigger points. The famous American investor, Michael Burry, understands how difficult it is to predict where a stock will end up, what might happen, and is it worth the risk. For every one of Michael Burry's predictions, you can just imagine that he's risking billions of dollars. That's when you know just how serious he is with these predictions and how careful he analyzes them. You can doubt him, but let me tell you that you should consider his words. From 2000 until the first quarter of 2008, he had a track record. He made millions of dollars for his investors, which had an average annual return of 28.6%, all thanks to his predictions. And he's confident and brave enough to make million-dollar predictions over and over again. So even if you have your own analysis, Burry's statements should still be taken into account. Although he wasn't that popular outside of finance until 2015, there were only a few people who believed in his predictions. But in 2005, when he bet against the housing market, since then, he's proven himself even more. Some people still didn't believe him despite his track records because he affirmed a bigger prediction, such as the collapse of America, which he predicted would have a significant influence on cryptocurrencies and even metals. Inflation is linked to practically all financial matters in society, which is something to consider in his predictions. According to Burry, the government's MMT-influenced policies are encouraging inflation, MMT standing for Macroeconomic Modeling Theory, which was developed by Warren Mosler, an American economist and theorist, along with Bill Mitchell, an Australian university professor in 1992. According to this notion, the government does not need to borrow money because it can just print more based on the demand. If the economy is in a severe crisis, it can simply print money on its own, and if the economy is booming, it can simply pull back through taxes and not have to print as much money. While this is currently being used by the Fed, not everyone agrees with the principles that are attached to the effects of MMT. When speaking before the Senate Banking Committee in February 2019, Fed Chairman Jerome Powell remarked, "The idea that deficits don't matter for countries that can borrow in their own currency is just wrong." He emphasized that the Fed's mission as the country's central bank is to keep the financial system stable and promote full employment. Warren Buffett is a renowned critic of MMT, and one of the reasons for its lack of widespread acceptance is that the same proposed solution led to terrible inflation in Austria, Hungary, Poland, and Weimar Germany during the first half of the 20th century. And, according to Thomas Sargent in the well-documented 1982 classic, the end of the four main inflations was due to the printing of money and monetizing debt. With the debt-to-GDP ratio reaching all-time highs, this only has a negative impact on the country. The GDP serves as the income in a debt-to-GDP ratio. Therefore, a high debt-to-GDP ratio may only suggest that the country isn't creating enough to pay off its debt. Even M2 money has hit an all-time high, indicating that the economy has printed more than enough money to cover such debt. When debt levels are high, banks will be unable to lend to the government to provide additional resources to pay off debts, because the government will not be able to deliver the services they require. Taxes will rise because they will be the only source of monetary value available to pay their debts. When taxes are raised, people will have less money to spend, which will affect businesses by cutting their income and causing them to lay off staff and so on. So as we expected, people were perplexed because rather than failing businesses, establishments were booming, as evidenced by the rising PMI charts over the years. This is the concept that there are resources available that may be used to pay off the government's debt without the need to issue and print more money. Burry believes the only explanation is the existence of hyperinflation. Otherwise, how else would you explain the lack of supply for all despite the rising economy? Burry couldn't help but reflect on how Germany came to be in this situation. Prices in Germany were steady, and both business and stock markets were booming. The exchange rate of the mark against the dollar and other currencies actually rose for a time, he tweeted. He then added in another tweet, recalling how only the wealthy people could actually afford such circumstances, and so people in poverty resorted to committing crimes as a way to cope with the rising prices from such hyperinflation. According to a series of tweets he posted on February 20, 2021, the situation in Germany during those times had truly built and prepared for a tremendous blow to Germany that they were not aware of: the buildup of all of the impacts of hyperinflation. Burry also said that people will only notice the obvious collapse taking place in front of them, but when hyperinflation occurred, the common people could no longer afford a much easier life because of a lack of money, even while everything around them was booming. There was already a collapse. Therefore, as with any other difficulty arising, you can believe there should be measures to protect what is yours and your daily needs. There are assets such as lands and jewelry that are worth investing in because naturally they appreciate in value. But according to Burry, the government will strive to control all of the assets available to the people in such a scenario. In his own words, he indicated in a tweet on February 18th that in an inflationary crisis, governments will take steps to squash competitors in the arena. #BTC, #gold. Although others may disagree with him because Bitcoin is decentralized and cannot be controlled by the government, Burry recognizes the long-term effects of the crypto's nature. He was describing how the rise of crypto was built on a lot of leverage, and that a minor price drop may also result in a massive price drop. This is precisely what Burry ended up stating in his latest tweet. If you don't know how much is involved in the run-up, you may not know enough to own it. And so you could ask if this is the only method to mitigate the impacts of this hyperinflation, which is expected to harm even the safest and most secure investments. When discussing hyperinflation, there are a few important terms to keep in mind. Here are some words that you probably already have heard of, but they are very important to keep in mind whenever we're talking about the crash of a market. First is capital costs. Capital costs are costs connected with a one-time investment on the acquisition or enhancement of a significant fixed asset, such as land buildings, that will be of use or benefit for more than one financial year. Input costs, on the other hand, is a set of costs incurred to create a product or service. In a hyperinflationary environment, it is essential to invest in companies that understand how to optimize capital expenses while minimizing input costs. Now moving on to the pricing power, which, according to an American investor and billionaire, Warren Buffett, is the most important factor. Pricing power is the power to improve the value of your hard work through your products without losing to the competition, and therefore is what makes your business a strong business. It is essentially the impact that raising or lowering a product's price has on demand for that product. And lastly, of course, there's interest rates, which inform you of how high the cost is to borrow money or how high the rewards are to save money. So if you're a borrower, the interest rate is the amount you're charged. Borrowing money as a proportion of the entire loan amount is how people who are quick to fail in an inflationary-driven environment fall even further down. This is because the obligation is added to them by borrowing money and acquiring loans on top of their want and need to survive in such a crisis. These are the factors that Burry evaluated when betting on stocks he believed were due to a crash, such as when he bet against Tesla, based on the fact that major firms require a lot of debt to stay afloat, leading him to believe that Tesla is running a business with a high interest rate. Michael Burry was once known for being exactly right with his predictions, but there were times when he was completely wrong, and one of which was his bet against Tesla. He thought it was ridiculous that people were looking forward to the company rising even higher in the market, but the people were right when it rallied and rose to 700% in pricing from just a 500% jump before taking a breather in April 2020. This merely demonstrates that you can surf over inflationary adversity, but it does not imply that you can disregard the main indicators of a crash. You just don't know yet. Maybe next time the odds could be in your favor and you could win your bets. Let me know what you think of Burry's predictions the next time he makes one, and if you utilize the same 4 points I used. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.